Hi, good morning everybody. This is Kang Wei here from PSR. Okay, so without further ado, we'll start today's webinar. Just to give you a quick overview of what we're doing today, we'll be talking about the US strategy with a focus on defensiveness. After that, Paul will do a quick market update on the Singapore market for September. And then Jeremy, our chief technical analyst, will be talking about his August review on his Phillip 20 portfolio. So let's get started. Okay, so just to do a quick recap on our last week's webinar, where Jeremy was talking about the US economic cycle. If you want more details on this, you can go through the archive. You can take a look at the presentation last week. But just to do a very quick recap. So Jeremy mentioned that we are likely in a late stage economic cycle, with this being the third largest, longest economic expansion in history at 98 months, where the average expansionary cycle is only about 60 months. But at the same time, even though we are at this late stage economic cycle, the bearish indicators have not yet been confirmed, indicating that in the short term, the market should still be pretty safe, and there's no signal of an imminent correction anytime soon. So with that, investors might want to continue to remain invested in equity markets in the US market, but you might want to be a bit defensive in nature at the same time to prepare yourself in the event that a correction really does come. So with that in mind, we decided to recommend this S&P 500 Dividend Aristocrats, which are tracked by the ETF, the ProShares S&P 500 Dividend Aristocrat ETF, with the ETF ticker NOBL, which I will just call Noble for the time being for this presentation. So don't get confused with the Singapore Share Noble. I'm not talking about the Singapore Share Noble here. I'm talking about this Dividend Aristocrat ETF. So just to give a quick introduction, the S&P 500 Dividend Aristocrats are basically a list of S&P 500 constituents. The criteria to be included in this list of constituents is basically that you must have increased your dividend payout for 25 consecutive years or more. So yeah, basically every single year you have to not only pay a dividend, but you have to increase that dividend payout every single year for a minimum of 25 years in order to be included in this list of Dividend Aristocrats list. The reason why we are recommending this particular ETF or this list of constituents is because first, as a defensive strategy, is because firstly, during the past two crises, the dot-com bubble as well as the global financial crisis, the GFC, they fell significantly less than the S&P 500 index. And after that, from peak to trough, during the recovery phase, the first 4 years after the crisis, they also recovered much faster than the S&P 500 index. And throughout the crisis, they continued to increase their dividends, so it gives investors income to weather through the crisis periods, so they have a bit more holding power throughout all these crisis periods. So let's take a look at what I mean. Before that, sorry, this is the S&P 500 Dividend Aristocrats. There's only about 50 shares included in this list. It's quite an exclusive list of the S&P 500. These are sorted by market cap as well as dividend yields and P ratios from last week. So first of all, the reason, like I mentioned, the reason why we're recommending the Noble, if investors are looking to be a bit more defensive in nature, is because it fell a lot less than the S&P index during the past two crises. So you can see in the 2007 to 2008, when during the global financial crisis, the blue line is the S&P 500 index, whereas the orange line is the Dividend Aristocrats tracked by the ETF Noble. So you can see that during the GFC, the S&P 500 fell by more than 50%, 56.78%, whereas the Noble fell only by 49.65%. Which is a outperformance of about 7%, which is significant. And then you can see also during the dot-com crisis between 2000 and 2001 that the S&P 500 dropped almost 50% as well, falling about 48.82%. And over the same time period, the constituents of the Noble actually fell less than 1%. And I personally feel that the dot-com bubble may be a better analogy for our current market situations, with the Nasdaq running hot for the past couple of years. So, seeing as the constituents of the Dividend Aristocrats have a dearth of technology stocks, it's not surprising that they have that when the dot-com bubble burst, that they barely fell a percentage point. So if you want to be even more defensive, we've decided to come up with a Phillip Ultra defensive portfolio, a sample portfolio picked up from more defensive sectors, namely healthcare, consumer staples, discretionary, as well as a little bit of energy stocks. So the reason why we picked the energy stocks, you can see in the table below that ExxonMobil and Chevron were the two that we picked. These are the very huge integrated oil majors that tend to be a bit more defensive in nature whenever crises come. Besides that, you have Johnson & Johnson, as well as Medtronic and AbbVie, who are part of the healthcare sector, which will also be a bit more defensive. Regardless of crisis, people still need to go and purchase their drugs or medical healthcare requirements. As well as consumer staples and discretionary from Johnson as well, Procter & Gamble, Walmart, Coca-Cola, and McDonald's, which are also, and Lowe's, which also tend to be a bit more defensive in nature and tend to regardless of whether whether the economy is in crisis or not, people still have to pick up their food, their soda, their shaving shampoo, etc. So, seeing as how this sample portfolio performed, you can see that it performed even better than the Noble when it came to the GFC, falling only 32.41% compared to the 49.65%, and of course compared to the S&P 56.78%. When you go back to the dot-com bubble, you can see that when the bubble burst, that this sample portfolio performed even better than the Noble, which fell barely 1%, and this sample portfolio fell only 0.08% compared to the 48.82% of the S&P 500 and the 0.93% of the Noble. So all in all, we can say that this, of course, there's no guarantee that come the next correction that these shares will not will fall less than the S&P 500 index, but looking at their previous performance during the previous two crises, we have a fair amount of confidence that the Noble as well as our sample portfolio should perform as a very well as a defensive line in your portfolio construction. Okay, so after the crisis, we also see that the Noble has outperformed the index on average if you take into account the 4 years post.com as well as 4 years post GFC. Later, the next slide, I will show you the comparative returns post GFC. On average, the Noble outperformed the index, and the effect is even more pronounced once you take into account the dividends. You can see in 2003, even though the S&P outperformed this Noble ETF, you have to take into account that the Dividend Aristocrats are actually recovering from a 0.93% fall compared to the S&P, which fell almost 50%. So taking that into account, you can see that the return is actually pretty impressive for 2003 relative to the S&P 500. And so you can see that once your dividends are taken into account, which is again what the Dividend Aristocrats are known for, the Noble beat the index on all 4 years post GFC. So not only do they fall less than the S&P 500 during crisis periods, but they also recover much faster after the crisis itself. Okay, and finally, the third point that we global financial crisis, GFC. Okay, so taking into account that the Dividend Aristocrats have a focus on dividends, as the name suggests, the criteria to be included in the list of constituents tracked by the Noble is that you have to increase your dividends every consecutive year for 25 years. So at a minimum, that means every stock in the list earlier has been growing their dividends since 1992, which means through the Asian financial crisis, through a Russian default, Argentine default, through the global financial crisis, through the dot-com bubble burst, through the European debt crisis. Not only have these lists of stocks been paying out a dividend, they have been increasing that dividend every single year for that period of time. And if you were to take a look at the this table, you can see that in our sample portfolio, that the shortest period of time for the shortest dividend growth streak that we have here comes from Chevron, which has 31 years of dividend growth, and the longest actually comes from Procter & Gamble, which has 60 years, which means even longer than the Asian financial crisis. You can see that through the Mexican default, Black Monday, Latin American debt crisis, etc., these companies have been paying out a dividend and also growing that dividend every single year. If you look back to the table again, you can see that the 5-year CAGR of the Dividend Aristocrats is about 9.77%. So just going by a very rough calculation, that means you can expect your dividends to double every 7 to 8 years. So for example, if a share is paying, just for example, 10 cents per share, that means you can roughly expect them to increase to 20 cents per share in the next 7 to 8 years. And then following that, another 7 to 8 years time, you can expect that 20 cents to become 40 cents, 80 cents, $1.60, etc., etc. And so if you take a look at the sample portfolio, the ultra defensive aristocrat portfolio that we constructed, you can see that the portfolio 5-year dividend CAGR is 9.11, but it actually takes into account a 0% from ABV. And the reason for that is that there isn't really a 5-year CAGR data for ABV because they were actually spun off from Abbott Laboratories in 2013. If you take into account the fact that their ABV's 3-year dividend growth rate actually is about 12.5%, you can estimate that the actual 5-year dividend CAGR for the sample portfolio will be higher than 9.11 and possibly even higher than 9.77%. So for Singapore investors, you do have to take note that you have to pay a withholding tax on your dividends. But even like I mentioned, the fact that these dividends keep increasing every single year is something that will be relevant for long-term holding investors because your yield on costs will continue to increase every single year. So for example, if we again take that 10 cents per share example, if you were to remove the 30%, you get 7 cents, and every 7 to 8 years you get a doubling effect. So you will see, from 7 cents go to 14 cents, go to 28 cents, go to 56 cents, etc., etc., depending on how long you continue holding the shares for. So we believe that with this dividend growing effect, that investors will continue to receive income throughout the downturn of crisis periods, and that will actually help investors to weather the storms of these downturns and not feel forced to sell off the shares during the worst period, which is the bottom of the crisis. You don't want to buy high and sell low. So with that, we've come to the summary, which is again that market conditions have yet to signal an imminent correction. As Jeremy mentioned last week, the bearish signals have not been confirmed, but we are in a late stage economic expansion. So therefore, investors, you can still remain invested in equity markets to continue reap the benefits of the bull market, but you might want to be defensive because since we are in such a late stage that you might want to be a bit more defensive in nature because we don't know when a crash or a correction will come. And we believe that the Dividend Aristocrats tracked by the Noble ETF will benefit because of limited downside during crisis period, faster recovery during the post-crisis period, as well as continually growing dividends which give clients, give investors holding power throughout the downturns of the period. So again, the ETF itself is called the ProShare S&P 500 Dividend Aristocrats ETF with the ticker code NOBL. And then the sample portfolio that we've constructed, the Phillip Ultra Defensive Aristocrats, you can see the list in the table there. It's just a sample. You can self-construct your own portfolio depending on which sector or which counter you actually like from the list of constituents earlier in the slides. If not, I will now pass on to Paul, who will give a short update on the Singapore market for September.
Yeah, thanks, Kangwei. This is on our Phillip Singapore strategy update that we produce every month. There's no change on our STI target. It remains at 3270. In terms of the key macro developments, what we find is that there is a synchronous global recovery. We find improvement in economic data across the board from Europe, to US, and also obviously in Asia. Global growth is tracking at 6-year highs. Based on the recent second quarter data, it could probably reach a 7-year high in terms of the global growth. One of the key foundations has been the electronic demand has been extremely buoyant. The other comment we have is that there's obviously the three worries on the market right now, which is North Korea, the US debt ceiling, and also the tighter monetary policy by central banks in Europe and obviously in the US. Our stance on these three worries is that on North Korea, we are obviously we are taking our base case is also the consensus view, which is that the regime's objective is ultimately to build up their nuclear capability and not to launch any particular first strike. In terms of the debt ceiling, with the Republican Party controlling both houses of Congress, we can safely assume that this will be passed through. After all, this is basically a budget that was created by the politicians themselves, and they've got every incentive to approve it. In terms of the tighter monetary policy that we see across the globe, the reason we are less worried is that the reason the tightening is purely due to the improvement in economic conditions rather than any runaway in inflation. Sorry, please ignore the US data mix. That's an error. So ultimately, we still think that the trajectory for the equity markets is still up, despite these three worries. And the main reason is that we do see economic data remain very robust across the globe. In terms of our strategy for Singapore, no real change. We still have buy yield and property. In terms of yield, our top picks are Asian Pay TV with the 11% yield and monopoly business. CCT due to the recovery in office rentals that we foresee. Mint and also Ascendas REIT due to the stability provided by the multiple properties that they have. In terms of property, it's CapitaLand and Wheelock and also CDL. And also we are starting to be more positive on the smaller cap property names as they have a more concentrated exposure to Singapore properties. Just to reiterate, one of our key buys has been Banyan Tree, and the main story behind this Banyan Tree is the large pipeline of hotel management contracts for the next several years after signing on with the two strategic partners, which is Venky and also Accor, which both parties has, just to reminder, have acquired stakes in Banyan Tree itself. In terms of coal, we initiated coverage in several coal stocks. Again, the ultimate driver for coal is that we expect coal prices to be range bound. Again, coal prices is ultimately going to be controlled by the NDRC or the Chinese authorities. They have a certain range or tolerance level for coal prices. And more importantly, for the Singapore listed coal miners, they are one of the fastest growing. Most of their mines are in Indonesia, and we expect them to double their production in 2 years by 2016 to 2018. In terms of some sector updates, the reason why we are holding our STI target is that the domestic sectors in Singapore remain soft. the retail numbers and obviously construction numbers that we see remains to be very poor. And also several sectors such as telecommunications and it's also facing structural challenges, not to mention the marine sector. One interesting data point that we saw was in June. We saw the hospitality, which is hotels and so forth, experience a nice bump in the RevPAR and tourist arrivals. Because it was festive season, so we need to track the July numbers to see whether is this just a seasonal festive reason or there's something more meaningful happening. And finally, we do note that as we move into 2018, that the banking sector will be enjoying some strong tailwinds. As you know, interest rates or the 3-month SIBOR are touching 18-month highs. The other driver will be the healthy capital markets will help drive the wealth management product division. Wealth management has been the fastest growing segment for the Singapore banks. And the overall improvement in economy, what we do expect is that as the external environment improves, this will help pull up all the various domestic sectors in Singapore. Thank you. I'll next move on to Jeremy on his technical outlook.
Hi, good morning everyone. Jeremy speaking here. So for my part, I'll just quickly run through the Phillip 20 portfolio. Basically the past month's performance in August. So without further ado, we first like to take a look on what happened to the broad-based market. For this case, we'll be looking at the STI. So STI for the month of August actually fell roughly around 1.6%, partly due to the ongoing war scare in Korean Peninsula. So what does the chart right now shows? So in the screen here, you are seeing the STI weekly chart. So what I want to point out over here is probably just run through what the chart is showing. So you can see since last year US election period of November, that was when the STI started to sort of move back to life and sort of started off this uptrend. But ultimately, you can see the uptrend that began since this start of the year sort of tapered around in June-ish period, whereby the resistance around this 3356 as well as the Fibonacci of 78.6% seems to be holding price down since June-July-ish period. As of now, what we are seeing is a key level to watch over here is the 3195 area. So the STI has been moving up pretty strongly since the start of the year, and as a result, you can see the RSI, which is shown in the bottom panel over here, sort of hitting the overbought kind of a territory since July period. The recent peak of the RSI on the weekly time frame stands at around 72. So combination of that sort of focuses us on this 3195 area. So the main focus right now, I think, is to watch to see this 3195 support area to hold. So ultimately, uptrend will remain valid as long as this 3195 area holds. But on the flip side, if this particular 3195 support area sort of breaks below, what we believe the STI from the chart perspective is the STI should continue to fall probably for a more prolonged kind of a correction. And what I mean by that is you can see historically the weekly RSI hardly exceeds the overbought or oversold territory. So the last time the weekly RSI actually hit an overbought, and what I mean by overbought is the RSI actually exceeding the 70 region. The last time that happened, it was around this period over here, which was in May of 2013. You can see this particular peak over here, whereby the RSI actually exceeded the 70 overbought region. So that actually coincided with a top over here back in May of 2013. And as you can see, once the mean reversion pattern plays out on the weekly RSI, whereby the RSI dips back below the 70 region, you can see the price action tend to signal a more prolonged kind of correction. And during that period, I think the STI corrected in a range of around 3 to 15%. So ultimately, I think the thing to watch out for on the STI right now is this key level at this 3195 support area. So long as this level holds, I think the uptrend should continue to push price higher for the STI. But on the flip side, if it breaks below this 3195 area, probably we will see a further deeper correction to probably even test this 3114 area or even to a low of around 2953 area. And hence, the realized P&L for August for our Phillip 20 portfolio. So on the screen, this is a table of the counters that actually hit take profit or stop loss. So with the STI down 1.6% for August, our P&L for August was also down, but to a lesser extent of negative 1.26%. So ultimately, the biggest loser of all was SunPower, which was in sort of a triggered and entered back in 30th March. Somehow or other liquidity sort of a drop for this particular counter, and this was the largest stop loss counter with a negative 27%. And UPP Holdings, MM2, Food Empire, Sheng Siong, and HMI all hit stop loss as well. So fortunately, Hi-P was the big winner of all to help buffer the big losses that we've seen in August. So Hi-P, we managed to hit a take profit of 48%, followed by Metro and UMS. And the reason why we took profit on these three counters is because we are seeing some sort of weakness in terms of the price action, which is the reason why we took profit on these three counters. And hence, net again, for the month of August, the Phillip 20 portfolio actually realized an average loss of negative 1.26%. And even with the sluggish price action from the broad-based STI, we managed to squeeze in a few new entries for the Phillip 20 portfolio. So here are the new counters that are being added to the Phillip 20 portfolio, namely Golden Energy, Ellipsis, Hoppa, Ten United, Miyoshi, and Moya. But do take note that we actually closed out our Moya Asia trade more recently in 5th September due to the ongoing weakness in terms of the price action. So what we saw on Moya Asia was that there was this downtrend line that has been sort of capping price down, and even with the more recent kind of bullish momentum, it's sort of still failed to break above that particular downtrend line, which is the reason why we sort of closed out that trade recently on 5th September. And with that, here's the current watch list that we are sort of looking at to add more stocks to our Phillip 20 portfolio. And all these counters over here are definitely moving in an uptrend kind of a trajectory. So what we are waiting for is to wait for some sort of pullback within these counters to latch on to the uptrend, which will be continued to monitor. And last but not least, here is the current P&L for the Phillip 20 portfolio. These are all the open trades, as well as the bottom panel over here, which shows you the realized P&L since inception, since May. So right now, the cumulative return since inception, this data was taken back, I think, last Friday. So as of last Friday, cumulative return since inception was at around 5.61%. Yeah, and with that, we have come to the end of today's webinar. We'll pause right now for Q&A if there is any questions. Thank you.
Hi, good morning guys, De Hong here. There's a question for Banyan Tree. Our target price is 74 cents. You can refer to all our reports on our website, that's stocksbnb.com. And then there is another question on the REITs saying that it has been an attractive investment going forward. Is this still the case? So REITs this year, they have performed very well because of the still relatively low inflation, which is keeping bond yields low. For going forward, we are more optimistic on two sectors, commercial and industrial. Uh, Commercial is because of the impending recovery and the rise in office rents that we foresee. And then you can see from our calls that we have accumulate or buy calls on Capital Commercial Trust, Maple Industrial, and Ascenders REIT. For hospitality, we do not have any coverage, but you can tell from the data that there is a bit of stabilization and signs of a rebound in RevPAR as well for local hotels.
Okay, there's a question on where you can buy the ProShares S&P 500 Dividend Aristocrat ETF. You can find it when under Poems. If you just search for the ticker NOBL, you should be able to find it there as well as the current price.
Hi, there's a question asking about whether the Phillip 20 portfolio are purely based on technical or combination of technicals and fundamental. Just to reiterate again, our Phillip 20 portfolio are purely based on technical analysis without any fundamental backing. So it's more of a trend trading kind of momentum strategy that we adopt over here to spot for potential trades within the portfolio. And as to whether dividends are being factored in, as of now, we haven't really added in the dividend part per se of the stocks that we actually entered. So maybe on a monthly basis, when we do the Phillip 20 portfolio update, we will sort of take a deeper look into it. But as of now, not many of the stocks that we are actually adding into our Phillip 20 portfolio does include the dividend segment of it.
Hi, okay, there's a question on how much charges does Poems impose on dividends received under the NOBL, and are there any custody charges? Okay, so as far as my understanding goes, there isn't custody charges for holding NOBL, and the charges for dividends are limited to just the withholding tax that you would normally receive from holding a US stock. But it would still be, I think, prudent for you to do a double check with your remiser or trade representative. Okay, so another question is it better to buy the Noble ETF or the individual stocks inside the ultra defensive portfolio? So it depends on whether you want to be ultra defensive or whether you are okay with the Noble ETF. So the on the upside for buying the individual stocks is that you can see from the earlier slides in the presentation, the chart, the drop in the the performance during crises is better, but you will still need to pay I think a bit more commission charge since you're buying each individual stock, whereas when you're buying the Noble ETF it's just a one-time transaction. I think for individual US stocks there may be custody fees as well, so it's just something to take note. Yeah.
Hi, there's a question on the Cromwell European REIT, the upcoming REIT. So the comparison between that REIT and KBS US REIT. So for US REITs, we do not cover them individually. So individually, I would not be able to comment. But for the upcoming IPO, the Cromwell REIT, that IPO is targeted to be for the end of the month, and the meetup with management could only be scheduled maybe 1 week before that. So I think post that meeting with management, we will be able to provide more information about the REIT.
Okay, so there is a question on what is the dividend that NOBL ETF actually pays itself. So as from what I checked, the latest dividend yield that they are paying based on its current price, they're yielding about 1.9% right now, but that may have changed as of Friday. I think you do need to just do a current check if you're buying. But again, the reason for the recommendation of NOBL is firstly to be defensive in nature, for it to in case you are fearful of a current correction, the price is by based on historical has dropped less than the index, as well as has a faster recovery. The dividends are a good to have to hold through in case of correction periods. Then you still have some amount of dividends income coming in, and as well as the fact that the dividends itself keep increasing. So even though the yield currently may not be super high, but if you continue holding it, eventually your yield on your cost on your original amount that you invested will continue to go up. Okay, we have another question on what's the historical year-on-year increases in the dividend yield of the ETF. So the ETF itself, the ProShares, they did not actually list the growth rate, but you can see based on the dividend increases of each individual constituents of the S&P, the average 5-year this is annual 5-year dividend CAGR. So it's about 9.77%. They do increase at for the different constituents, they do increase at differing rates, but the average out for the 50 shares in the constituents for the past 5 years has been about 9.77%.
Okay, we have a question on when will Centurion be listing their having their dual listed doing the dual listing on the Hong Kong Stock Exchange. That will be no specific dates yet, but they are targeting October 2017 for the listing. Some of the recent developments has been the major shareholders have exercised their warrants, so it has increased the amount of funding into the company. Thanks.
Okay, thanks guys for tuning in for this week's webinar. We'll see you guys again next week, and yeah, do remember to subscribe and sign in to the for the archive webinars, as well as to check out our stocks BNB for our reports. Thanks.